Welcome to Markets Now. I'm Michelle Rourke along with Kent Beadle with Paradigm Futures. We are seeing some mixed trade in both the grain and livestock futures trade this morning. Kent, I want to start off by talking about the corn market. We had higher day on Friday, although lower weekly closes, but we are definitely trading weather and maybe some ideas of not only lower crop ratings in this afternoon's report, but also maybe some tightening of yield.
Yeah, we did not see any adjustment to yield on last week's report, despite last Monday's, large decline in condition ratings. The market was certainly optimistic about seeing some good rain and coverage this weekend. And ultimately, I think that the systems that came through were fairly disappointing. There was a string through central Minnesota that gave growers a little bit of a drink. There was a part of south central Illinois that got some rain, parts of southern Iowa that got some rain. But all in all, the amounts of rainfall that fell and the coverage levels that we got out of that system just were not as good as what the models had forecast, really all the way until maybe 11 o'clock on Friday. And then we saw that we definitely started taking rain out on that model. And what we got this weekend just wasn't very good. And that's certainly driving corn futures here this morning.
Absolutely. We did manage to get the corn market here, the December contract, close to that resistance level last week, that 547.5, couldn't take it out. Will we be able to close above that? And if we do, what does that open the door to?
Well, first of all, I think that it may take a couple of runs at it before we do get through it. Historically, we haven't rallied very much off the lows, or we're still at some fairly subdued levels relative to insurance values or the January high, whatever type of measure you want to look at. We've got a ways to go to get to some historical normal rally type levels that farmers typically rely on to make sales. But if we do manage to get a close above 47.5, then we've got some moving average resistance up around 665. We have a downtrend line up there. And of course, we had some old highs around 376 or 576 or 577 that I think a lot of growers would really like to see to extend some of their marketing.
You bet. All right, soybean market, we did close higher on Friday, and the soybean oil market's really been pushing that market. We've seen a little bit of demand news that's been somewhat friendly, but is that what's really driving these markets or not?
Well, I first of all, the speculator had pretty much exited their full position and have been a little bit on the short side here as of the last couple of weeks, and so they've got a lot of room to buy this thing if they want to. Weather is not as critical for the soybeans, and yet I think we're still trading that a little bit. But you're right, the demand has started to reemerge. We had a spot sale to unknown for 198,000 tons. We had 165,000 tons of beans go to Spain. We're hearing some rumors about some things in soybean oil that have given us a boost. And certainly when we moved soybean oil underneath 50 cents a pound, I think the renewable diesel industry, more than likely saw an opportunity to get some, pricing done against that input supply, against their, renewable diesel production. And I think that helped the market out as well.
So we've been seeing the bull spreads work, and undoubtedly there's a lot of folks thinking, we do have the titled crop supplies, maybe even a little overstated by USDA. But today we're seeing some unwinding of that spread. Any particular reason why, especially when you've got meal up?
A couple of things. First of all, we are in the midst of the Goldman roll, so that passive long is, systematically moving that length forward, and that generally weighs on spreads a little bit. We've also seen a lot of basis shifting in the country. We've seen July corn basis getting rolled to the SEP. We've seen July soybean basis getting rolled to the August. With the big inverses that we have, oftentimes at this moment in the cycle, you'll see the commercial trade roll their bids ahead, and then they'll pocket some of that inverse. Okay, and so you actually end up with a basis levels that are actually a little worse than, or a flat price that's a little bit worse to the farmer. And that tends to get people nervous. And so then you get a day like today when weather drives things higher, and you start to see the farmer actually take advantage of the rally and get some things sold. Keep in mind, too, that there are open basis contracts out there that farmers are going to need to price between now and the end of the third week in June. And so again, on a rally like the one we're having today, you'll get some cash movement that'll start to weigh on those spreads a little bit.
Technically, though, we did get the November soybeans back above the $12 mark, and I don't know if we can keep that going. What's the next target there?
1245-ish is what I'm looking for, and then honestly, we are such a long way from insurance prices and January high. There's a long way to run in the beans if we were to actually threaten the crop. Again, this is a time frame where we're just a little less concerned about dryness in soybeans, because we know that the yields are going to be determined by August rainfall, and we know that you can have short plants that don't look particularly healthy rebound to actually give us very good yields if you get that August moisture.
And what about the wheat market? Kind of a disappointing week last week in light of the fact that we had a lot of what could have been bullishly construed Ukraine headlines, including the dam there being blown up. But we had world ending stocks, which were raised almost 6.5 million metric tons. So is the market just trying to sort through all that, or what?
Yeah, I think so. And you also had a little bit of bullish news out of Australia with a small downgrade. Size of that crop relative to USDA estimates. It just feels as though the market is maybe a little bit asleep at the wheel here on the Ukraine situation. I think we're losing significant numbers of acres to flooding. We have the potential to lose a lot more acres to a loss of irrigation water that was coming from that reservoir that is now flowing and doing the flooding downstream. There's renewed hostilities or escalating hostilities that just make you wonder what the long-term agricultural future is for Ukraine, and whether or not the world is going to be able to rely on that breadbasket of the world to supply the kind of grain supplies that they have in the past. So we seem to be discounting it. It feels like the speculator likes selling wheat against longs in corn and soybeans if we are going to trade weather. So there's a little of that going on, and you also keep in mind that the wheat is just very thin and not particularly liquid right now, and it's been resulting in 20 and 30 cent moves one direction or another on a regular basis, and that has a tendency to drive a lot of small traders out because of the volatility.
Yeah, it has been volatile. Cattle market's been a little volatile as well. Some consolidation off the key reversals from last week. Do you think that we have a little bit more profit taking or more of a correction to come here, or are we through that, and will we be higher this week if cash trade is back higher?
Well, what I think is going to happen is that any more significant pullbacks are still going to be well supported. Okay. We're not going to allow the market to trade at huge discounts to the cash. That being said, the size of the cash market rally over these last couple of weeks has been historical, and it's it was certainly well forecasted. I mean, we all looked at the fundamentals and said, "Boy, this could be really, really something," and the size of the gains were huge. That being said, we're likely getting to a point where we're going to top that cash market out. And as the market starts to think that we're going to pull cash market back, the futures doing what they always do, anticipate that and are discounting the future against the highs that we've recently made. If we make new highs in the cash, yeah, we'll go up.
And the hog market, we did have a higher weekly close last week. Can we keep building on it?
Well, cash markets there also very important. And, we were wondering if we were ever going to get our seasonal rally in cash hogs. It's finally here. It's upon us. We're hearing the packers are short bought. They're looking for pigs. We're obviously been a little hotter, and, production is going to start to suffer here a little bit if we start to bring heat back in, and that is in the forecast. So a lot of things kind of coming together. I think that we can do a little bit better, but I'm looking at this rally as another hedging opportunity for people in the business. I'm, encouraging people to look at margins, especially further out on the curve where you might be able to lock some profitability down after what's been a pretty tough period for margins.
Absolutely. So some good advice. Thanks for joining us this morning. Kent Beadle with Paradigm Futures. That's Markets Now.